Markets don't turn on data, they turn on confidence. One whisper of falling rates, one signal of stability, and suddenly the crowd believes again. Right now, the numbers say calm, cautious, subdued, but the undercurrent tells another story. Most people look at house prices and see numbers. Nick Goodall sees psychology, the patterns, the hidden levers. Investors want to know, is this the crossroads where property quietly resets for the next wave?
Financial freedom faster. Financial freedom faster.
If you're waiting for the perfect moment, you've already missed it. The market doesn't wait. It moves. And the Mortgage HQ Snapshot isn't polite. It's a slap in the face, the kind that wakes you up, gets you off the fence and into the game. Take the shortcut. It's direct, it's sharp, and it's sitting in the description. Nick, how will the direction of the official cash rate shape property investment decisions in New Zealand?
I think it's loosened regulation. We know the bright line test is shortened. Interest deductibility has come back, so you can get some of that, interest cost back on your tax return at the end of the year, which improves your cash flow from a yearly basis. But I think the key factor is absolutely falling interest rates. Falling interest rates means that you can borrow more, you can afford to maybe pay more for a property, but are you also getting slightly higher yield on your property as well because your mortgage payments are coming down? And as you said, people could actually shift to interest only if they wanted to really reduce their mortgage payments. That would help with their cash flow, but they need to have some protection for the future because obviously the equity may not grow at the same rate if property prices don't increase as much in the future, and they're not actually paying down any principal as well. So there's a number of things to be wary of there. But I think in terms of the overall environment for an investor, things are better today than they were a couple of years ago. And that means that they can make some of these purchases actually work financially. And we're seeing that come through in the data as well.
And how are the rising rental yields reshaping the investment equation? And I want to highlight a specific region as an example. It seems like first-home buyers are making a bigger play in Christchurch. Does that mean that it's a less attractive area for investment for investors? Like, where should investors be looking?
Yeah, I don't think that's necessarily a reason not to look in Christchurch for opportunity there. When you look at the actual average rental or median rental price there, it's $545, which is still relatively affordable. Now, of course, it's going to depend on what property you can buy to better rent that property out. We have seen rents essentially flatten out in Christchurch as well. So we may be coming to a point where Christchurch is reaching some form of, equilibrium between demand and supply. We know the supply growth in Christchurch and the broader region has been just huge over the last 5, 10, 15 years since the earthquakes of 2010, 2011. Maybe that supply is finally keeping up with demand, and so we're seeing rental prices flatten out. We're not seeing the same level of growth in property prices either, but just because first-home buyers are finding it, an opportune time to enter that market, that's just a sign that, there is good, high quality, relatively affordable property based on the income that those first home buyers can earn and buy in Christchurch. Doesn't mean there's an opportunity for investors and also for people that want to rent in Christchurch as well. When you talk to people that might be university leavers, if you're weighing up Auckland, Wellington and Christchurch to go to university or to leave university and find that first job, Christchurch still looks pretty appealing, especially when you add in the quality of property you're likely to get because of that renewal of stock. So the affordability measures right now between Wellington and Christchurch are quite similar, but I can hazard a pretty strong guess here that the quality of the property you'll be buying or renting in Christchurch will be newer and better than the old stock you'll be buying in Wellington. So it's all these things that need to be weighed up. That might mean there's more opportunity for an investor in Wellington if you're someone that does up a property and increases the quality to try and increase the rent off the back of that. So there's going to be different motivators in these cities, but you need to weigh all those different things up, understand who your tenants might be, and then you can try and find the opportunity of what's going to work for you and looking at that growth and yield as well, which has been occurring as interest rates fall.
And how do you see the investor momentum building into 2026 for this property cycle? Are we going to come out of this bottom?
Yeah, I think eventually there'll be some growth in the market. It is really reliant on an improving economy and an improving job market. That's when people are going to feel confident. They're going to be back out there looking at that next home. For owner-occupiers that move home, they've been very restrained in their activity the last few years as they haven't been 100% sure if their job's going to still be for them, next month, next year. And so that's just holding back those owner-occupiers. For investors, the equation continues to get better as interest rates fall. And then for those that are buying with some expectation of capital growth, as I say, when the economy improves, labor market improves, we're likely to see that flow through to some level of increasing property prices. But I'm always, cautious to tell people that, don't expect the same levels of growth that we might have seen in the past few decades, where you average 6 or 7% per annum, maybe more down that 3 or 4%. So as long as you can make the numbers stack up from that perspective, the opportunity is still there. The leverage opportunity is still there. And holding that property long term and offering a house up for someone that needs to live in it can still be really rewarding for many people as well. So, yeah, look, it's about being on your numbers and talking to those that have been in the market for a while, I think.
And why are mortgaged multiple property owners returning? What is this signal for the market?
I think they're finding value again. Interest rates coming down, their mortgage payments are reducing. It's meaning their top up to their mortgage isn't quite as much, given they're covering quite a few costs at the moment as well. Many things we've spoken about hitting those investors, whether it's insurance rates, council rates, all of these things are affecting anyone that owns the property. And as long as they can, reduce their mortgage payments, then they can start to see a bit of a better yield than what they did a couple of years ago. Now, for many people, they're still likely topping up their mortgage, so it's maybe not making sense on a cash flow basis. That means they're buying based on some expectation of future capital growth. It is improving, but as I said, this turnaround is taking longer than we expected. So it's just about setting those expectations that, hey, look, we're not expecting the market to suddenly take off once again. Even when the labor market and the economy improves, it's likely to be a bit of a slow grind back out of this downturn.
And what's the story with the existing listings and new listings? How's the market reacting?
Yeah, new listings for sale are pretty consistent with previous years. So we're still seeing a decent number of people come to market. No panic out there of people trying to exit the market, but equally not people holding back from listing their property either. So we're in a pretty normal phase for winter, especially for people listing their property every week. In terms of total stock is declining now. It has been, and it does always through winter, but the rate of decline this year is a greater rate of decline than previous years. Now, one of the main reasons for that is actually because of the increase in the number of sales that are occurring. So we're still seeing strong turnover of properties year on year. For example, nationwide, we're seeing 15% more transactions occur in the last 3 months than the same 3 months the year before. So properties are turning over, but because this balance of demand and supply is, still favoring the supply side, we're not seeing the growth in property prices come off the back of that. So transactions are occurring, but vendors have to be realistic with their prices. They can get that sale. It's taking a little bit longer, but that is overall, that lift in transactions is meaning that overall levels of stock are declining now. Now, it's still a buyer's market. The buyer still holds that power, but it is starting to turn around. And so we're starting to see that power maybe drift a little bit more towards the vendor. And it does differ by region as well. Now, I'm not saying it's a seller's market by any means. We're still up when you compare to the longer term history, say 4 or 5 year average for this time of year. We're still up based on that average, but we're down year on year. So we're starting to see it turn. In some areas, there's a greater decline in total listings. Places like Southland and Gisborne have got way fewer properties available for sale today than they did a year ago. So in those areas, you might see, sellers have a bit more power. They can actually start to expect a higher price because the choice is much lower for buyers. But at the other end of the scale, Otago, Northland, Canterbury are still only a little bit below last year's level of stock. So in those areas, the buyers still have lots of choice. And so again, they're not going to panic. There's not going to be as much upward price pressure in those areas. So yeah, listen, check out, I suppose, our latest monthly chart pack. It's got all the detailed stuff that we've spoken about today. And it does put each of those regions on a chart to show you how it compares year on year. And some of those areas might be more inclined to see a turnaround in prices sooner than others if their stock levels have reduced by more than those that haven't.
Well, as we get closer to the election next year, the investors will start thinking about consequences of what goes on. What is likely to happen if the interest deductibility rules change again or bright line rules change again? If we're in the same rates in the same market we're in today, what would your expectations be to property values then?
Yeah, I mean, any extra regulation on investor activity, so anything that makes it less attractive to buy and own property, is going to see reduced demand from investors, which will mean less upward price pressure, I suppose. The question around the election itself, I think it's going to be a really interesting one, because I think all governments, all major parties know that if we go into an election year and the economy is not doing well and people don't feel comfortable about their jobs, they're likely to vote for change. And so I think this government will be very conscious of that. That's why they're so keen to see the economy start to lift. That's why there's been conversations about their expectations on what the Reserve Bank should do. And they've been sort of hoping they'll be cut by, more than otherwise, because they know that we need to get out of this recession or this difficult period for the economy to be a much more happier bunch. And then we're more likely to continue to vote for the incumbent government. So there's some big questions there. I think as long as we do come out of that, then there's more likelihood of staying with the current government. If that's the case, then those changes, like I said, the regulations of bright line tests or interest deductibility, they're unlikely to change. If we get a change in government, would the new government go back to that? Don't know. I mean, there'd be an argument about continually swinging between these regulations and that not really being very helpful across the board. But if they feel that strongly, then maybe we do have to start to entertain that prospect. But we're some way away yet. I'd say at least a year away. So we'll certainly see a lot more politics played between now and then to see where that might head.
Nick Goodall, Cotality, appreciate your insights today and look forward to catching up again soon.
Always good to chat. Appreciate it, Andrew. Thanks, mate.
You want ammunition, moves that work, tactics that win? The 3 property formula is the playbook smart Kiwis are already using, while the rest are still refreshing Trade Me and panicking at interest rates. No fluff, no webinars, just results from the front lines. Get the strategy and own the edge. Grab the book before someone else buys your future.